How do you navigate your financial wealth and well-being? Well, listen today to Bernard Reisz, who is going to help demystify so much of the strategies that you should or should not deploy and how to understand which strategies will work best for you. Now, we don't get too into the specifics, into the weeds on so much of it, but we're really getting into the ideology, the thinking behind, and the process so that you can understand, how do I know who's going to be working for me? Because everybody is out there selling something and they seem like they're my friends, they seem trustworthy, and they seem like they understand really well the products that they're selling, but are they really doing me the best service ever? Okay, so we're going to talk about how to vet those people in your life to preserve and protect and grow your wealth, your well-being. If you haven't already subscribed, liked, reviewed, rated, shared, all those wonderful things, I would be absolutely honored if you took a moment to do that. That helps Ask Me How I Know grow in a powerful way. Like, you have no idea what your ratings and reviews do to get this podcast out to more listeners. But remember, we're growing organically. I don't hire people to go out and promote and share this podcast, but I'm relying on my awesome audience. Also, remember, I want to hear from you. I'm creating content for members in the audience because they've reached out to me and they've said, hey, Julie, I want to know more about this or this or this, and I'm creating the content for that. So if there's something that you want to learn more about, please reach out. There's a way to connect with me in the show notes, or you can always head over to LinkedIn. Make sure you connect with me and let me know. And if it's not something I normally talk about on the podcast, I might just make you a special episode. Bernard, thank you so much for joining me on another awesome episode of Ask Me How I Know. I'm so excited to have you here after months of waiting.
Julie, thank you so much for having me. I've been looking forward to this for months and months as well. And I think we're having the conversation at a good time of the year where people are thinking about their taxes or perhaps dreading them or trying not to think about them. But this is the time.
This is a time, and this is exactly why I wanted to have you on Ask Me How I Know, because there's so much misinformation out there, and so many people have these weird relationships with their taxes, like, oh, let me overpay so I get a refund. What? Let me give the government my money so they can give it back to me and they can leverage it. Like, there are just so many wild things out there. And I really wanted to unpack, just how we can help people understand the strategies with taxes and how to navigate this with their finances.
Yeah, that's great. And I really see that kind of behavior you describe every day. People are like upset. This year, I got a smaller refund than last year. And I'm like, you should be happy you got a smaller refund, because that means you didn't give any interest-free loans to Uncle Sam. And sometimes people want to know, it goes the other way. People want to know, oh, I have to make my estimated tax payments, right? And they're all in a panic about it. Yeah, and you should do it. But, if you have better uses for the money, okay, just borrow from the bank of Uncle Sam and pay him later. They're a great lender. They don't pull your credit score. There's no underwriting. You just keep the money. So absolutely. It's just, who's lending who the money at attractive interest rates?
That's right. And so often the roles are reversed. And I'm just going to say it sounds predatory on the good nature of citizens wanting to do the right thing of, okay, well, I got to do this. I got to follow the rules and fall in line.
and did you break the rules? The rules are designed, right? If you do tax evasion, all right, maybe that's morally wrong. But the government essentially says, okay, you can pay your estimated payments by this point, or pay later and pay us a little more. Didn't break the rules if you did it that way, right? That's within the rules. You're just paying them a little later, and you're paying for that right.
I think that might have cleared some things up for some people out there. Because I know that I didn't understand that. And I'm very much a rule follower. And the gray area, I can maybe go into like the very lightest shade of gray in life, then the rest of it makes me really uncomfortable. So, there are other people out there like me where they're like, well, but this is what I have to do. My CPA, my tax office, they gave me these vouchers and they have a date on them and I must do this. But you're right. There is the alternative set of rules, or, hey, well, here's what else you can do.
Yeah. And it's just, here's what I say. View everything tax related the same way you view an investment. And that means to say, assess your risk-adjusted ROI on anything that you do in the realm of tax, right? Obviously, fraud and evasion is not part of this discussion. So we're talking within the realm of what reasonable people would do. So whether you're presented with a certain tax strategy or being told not to do something, always think, okay, what are the potential outcomes here? What's the impact this is going to have? Let's take it. If I do this, I will have this amount, much more money in the bank if I do this. Oh, but there is a risk because this falls into some gray area perhaps, or not so clear, or one of those things that is a facts and circumstances thing. And what that means is sometimes the rules are bright and clear, and sometimes it's subjective how to apply them, because the law is clear, but no two set of circumstances are alike. And the tax code can't possibly outline all the infinite possibilities of scenarios that could present themselves. So this scenario, where does it fall? It's facts and circumstances. Yes, it is possible to view it this way. It's possible to the other way. I'll take this position. Okay, what happens if there's an audit? Okay, now what's gonna happen then? They throw me in jail? No, we're not fraud, right? Worst case scenario, maybe they disallow the deduction. Maybe there's some interest. Well, maybe there's some penalty. You can put that in a spreadsheet and come up with your expected return on this position, right? What's the expected value? So it really is viewing taxes like an investment. That's exactly it.
That's a completely new way of thinking about this for a lot of people, and I have, within the audience, there are a lot of newer investors who are, venturing down. They're maybe diversifying off of Wall Street and starting into this whole real estate or alternative investing. And there are all these other tax strategies that can be implemented when you're going down those rabbit holes and going into new territory. It's like, oh, look at this, shiny new objects everywhere. So
yes. And that, to take the analogy further, because there are, for the most part, what's great about real estate and taxation is that the tools that are available are above board, right? Depreciation, there's no question about that. In fact, you're required to take it. And so it's not even, and if, for example, there's something called depreciation recapture, which is to a certain limited extent, if you have enough appreciation and you have enough of a capital gain when you exit, you got to pay back some of that depreciation that you claimed. And some people, you'll think that, oh, I never claimed the depreciation for whatever reason, right? So I don't have to recapture it. And the rule is, and this is black and white, you have to reclaim whatever you could have claimed, even if you never claimed that deduction. So claim it, because you're going to pay for that deduction to a certain extent, whether or not you took it. So may as well get the benefit of the cash flow up front, because you're going to have to recapture whether or not you claim that. So depreciation, above board. 1031, above board. Cost segregation, above board. These are not risky things. Of course, you could have certain structures that can fall into, but overall, these are in the code, black and white, extensive regulations. The IRS has told us exactly how to do it. But there are a whole other set of stuff where people kind of forget view taxes again like an investment. And so just like when you come to a property, you're going to buy a 200 unit property, you're going to perform due diligence, right? If you're going to give your money to a syndicator, right, you're going to hand over, all right, maybe you're not the operator or the syndicator, you're not running the deal, but you're handing over your money to the deal operator. You're going to do due diligence. You're going to say, hey, do these guys know anything about real estate? What do they know? What's their experience? Or are they just some guys that lost their jobs yesterday and said, okay, let's raise money for real estate, right? You're going to do your due diligence. Taxes is the same thing. I'm consistently surprised how people forget that just because somebody dangles some sort of tax tool in front of you doesn't mean you should do it, right? So 1031 exchange, that is above board. Certain other things that are tossed around out there, once you move away from the stuff that are above board, it's very hard to get accurate and complete information. So for taxes, just like you do an investment, you need to do due diligence. Okay, who's presenting this? Just if somebody presented you with a real estate opportunity and they gave you pro forma projections, right, you would say, okay, do these guys have any reason why we would assume that their pro formas are valid, right? And so you'll say, okay, they have a background. They've been operating and running deals for X amount of years, and they have this and this track record. If somebody dangles a tax tool in front of you, you should be asking, what's their role in this? What's their background in tax? What's their incentive here? How do they operate? And just like in the fund space, there are folks that are doing right by their investors and giving them ROI through smart assets. And then there's the opposite. In tax, it's the same thing. Your taxes, it's like an asset. You're buying a tool. You're buying an asset that's going to create ROI. Are you getting a real asset, or are you getting something that perhaps you shouldn't be getting into?
And that's so, I've never heard it put like that. Okay, well, you put it like that in other spaces, but that is a new concept for most people listening. And they'll think, well, I picked up the phone, I called this, this particular office, sounded good, I just needed to get it done. And for people, especially as they're just broaching into new spaces, they're not realizing these tax implications. I have some friends that, started flipping houses at one point, and they didn't think about the tax liability that they were going to have because they were making all these gains and everything. It's like, well, whoops, we just got hit with this big bill. So as people go into new spaces, there are all these different things that they don't understand, and they don't know how to ask all the right questions. And that goes into house flipping or any type of, go into Bitcoin. Well, there's going to be a whole nother set of implications over there. We go into, everything has its own little choose your own adventure. Is that right? Am I understanding that correctly?
Absolutely. It's what makes this so much fun and entertaining and engaging. But everything is its own world. Within real estate, are you flipping? Are you wholesaling? Are you buying and holding? Are you doing what's the asset class? Is it a short-term rental? And from your own tax profile, right? Are you still holding down a W-2 job? What is your tax profile to know to what extent you're going to get hit with taxes? You may benefit from an SCorp, or an SCorp may actually hurt you. I must have, I don't know how many investors I've spoken to that have been told, get an SCorp, and the SCorp is actually causing them to pay more taxes, not less. So it's varies. I've even had a story. I worked with somebody, a client, right? So we worked with them to set up their retirement account to invest in real estate.
Okay.
Now, this particular client was a CFO of a company, substantial enough, not a meaningfully sized company, a CPA that was working as a CFO, and she had attorneys working with her, and we were just helping her set up her retirement plan for real estate investing. And she's like, okay, I'm setting up, she has a job with this company, and she's going to set up, does some consulting, and she's setting up an SCorp because that's going to help her for her taxes. And her attorneys also advised her that. So she's a CPA, she's working with attorneys. So this is not somebody that's trying to cut corners, right? And taking some info off the internet.
Highly educated person, highly successful person, engaging with other successful professionals in their field of expertise so that she can stay above, above the bar and have the best experience.
And we were brought in just to do the retirement account, right? But the benefit, let's say being that we get the full picture, we're like, no, this SCorp it's going to hurt you. You're going to pay more taxes by having an SCorp. And sometimes people don't like being told that because they're already so dead set on things. And we actually run the risk of, from running a business perspective, you just want things to be smooth. You don't want to tell, but we wanted to help her. Right. And so, ultimately we explained to her why having an S-Corp is going to be costing her more money in taxes. And she didn't do that. But there is.
Wait, she didn't do the S-Corp?
That's right.
She didn't take your advice. Okay, good. No, I'm like, wait, she didn't take your advice. Oh no. I was getting concerned. I'm thinking, oh, poor her. Okay.
Yeah, she did not do the S-Corp. And then there are people, S-Corp is pitched as a way to save on self-employment tax. But there are many, many, many hidden pitfalls to having an S-Corp. But one of the biggest ones is people that have a W-2 where they have substantial income. For those people, if they have a side hustle, doing that as an S-Corp will actually cost them more. So if somebody is truly, totally self-employed, right, at a certain income level, it may make sense to have an S-Corp. But if you have a job where you're well compensated and you getting a W-2 there, and then you have your side hustle where you're doing well, in that side hustle, an S-Corp will probably cost you more taxes than it will save you. Which is the scenario that this CFO had. So taxes, to bring this full circle, is what do you need? The internet never can account for all the nuances of any particular scenario.
You mean I can't just go plop onto TurboTax and just put numbers in from little boxes?
The TurboTax can be a good fit, for people that all they have is their W-2. TurboTax, go for it. I love it. I just had a huge debate on LinkedIn. This goes back, I don't know, it's a month now. So I don't like that asset under management fee that financial advisors charge for a whole lot of reasons. And one aspect of it is that it's an industry that's designed not to empower. It's an industry that wants to foster dependency. They don't want to educate you. They deliberately want to use some sort of jargon that makes it sound like they know stuff that you don't. And is it okay if is anybody get offended by this if I pick on the financial advisors?
No. So my podcast is a free space because we want to hear the real, someone's real perspective. You're fine. Okay.
Right. So, and again, no individuals. This is just generalizing within the industry.
Yes.
Right. So if I can help my clients and educate them and they go to TurboTax, great. It's not better for the economy, for the world. Nobody's adding value if people can just go to TurboTax. Right. So I was, part of this debate was you guys are reducing people's net wealth by about 60%. Over 30 years, the reduction in net wealth if you have a financial advisor is about 60%. Pretty insane. But the thing is that nobody sees that because then it trickles out and you're not accounting for the lost profits and compounding on that money that you paid the financial advisor, right? So the actual reduction in net wealth is about 60%. And the way this gets perpetuated is because they keep you feeling like there's some sort of magic that they know that you don't know, right? And apparently you're not capable of understanding, right? And that's what perpetuates it. And I was saying, hey, guys, your clients will come out way ahead if they just do ABC that they can do themselves or teach them how to do it. And I got this pushback is like, what do you mean? You're a CPA. Do you want your clients to go to TurboTax? And I'm like, hell yeah. If they can do TurboTax, they should. I'm not helping anybody and not adding any value. And I said, I'm waiting for the taxpayer that's going to let me charge them a percentage of their gross revenue for the tax return, right? There's a fee for a service. You add value, you get compensated. Are you adding value that's commensurate with being paid 60% of a person's net worth over 30 years? So TurboTax, if it works, by all means. And if I have people call me up and say, Bernard, I want a consultation, I'm going to do TurboTax. And I'll, you know what? I don't like doing tax returns. I wish, right? I don't even like it, right? I'd rather do the advisory and you do the tax return. I love TurboTax for the people that it works for.
Yeah. So I have to go back to the LinkedIn conversation, because if I were listening to this, I'd be curious and wondering. So did they come back and respond to you after that?
Yeah. So I was pretty amazed. 1 or 2 fellows came back. I can send you the link. You can check it out. But at some point, it just, it stops. It's an industry that doesn't want to empower. That's all. And we want to really add value the way we add value to the universe. We raise everybody up, and it's an industry that's built on kind of keeping people down and having them feeling dependent, and like there's some sort of magic crystal balls that they have. I don't know what it is. Now I have a securities license, so I've been through all that. So I tell you, when
you've seen behind the curtain, basically.
Oh yes. And when I passed the security exam, I did not get a crystal ball. I thought I was going to pass the exam. Yeah. And I thought I'm going to get the crystal ball that's going to tell me tomorrow the market's going up or going down. And I don't know. Maybe they skipped me. I'm not sure what happened.
That's so disappointing. They need to refund. They need to give you a refund. But I hope that's an aha for a lot of people. And so when we're thinking about financial planners, when we're thinking about, wealth management strategies and everything, which is more where you come in, is like, hey, let's manage this. Let's manage your wealth, and let's position you in a way that you're going to grow your wealth. And I'm not going to be like sucking you dry like a vampire. But hopefully people are hearing this and having this little light bulb moment. That's what I'm really hoping for, is that taking charge of your wealth, taking initiative. And that's where, I'm not sure about you, but Bernard, this is where I see a lot of people, particularly my female counterparts out there, is that there's a larger lack of disengagement. Like, I don't want to, we're so bombarded by information and we have so much on our plates. Like, I don't want to learn one more thing. Do I really need to understand this? So how much should someone understand when it comes to, setting themselves up for taxes and strategies and just overall financial management? Like, how much does an average person really need to educate themselves to be successful?
Yeah, awesome question. And so I to put the context in place, I think there are many, 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 infinite number of ways. And it's really whatever rocks your boat. You just need to understand how the space operates and how to interact with it. Right. So I think many people should use a financial advisor, but they have to understand what the value that a financial advisor can deliver. Like, what do you really want from them? Right. And then when you know what you need from them and what the value to associate with that is, then you can know how to select it. Right now, people are like, oh, I don't know, there's money stuff, I can't deal with it. Let's find a financial advisor. And the financial advisor, and you just kind of pass it off, and there's no real selection process and understanding. Again, it always comes back, look at it like an investment, right? And let's use real estate as an analogy again. When you interact with financial space, you have to understand conflicts of interest. That is an alignment of interest. You have to understand who's really on your side and who's your counterparty. Now, what's unique in the financial space is that the people that are really at the opposite side of the table present themselves as being on your side, right? And so you forget that, no, I am the commission, right? I'm the commission.
You
right?
are their carrot.
Exactly. So that's what's unique in the financial space, is that it's built on developing trust. And again, trust is always needed, but it's in most other environments, you understand that there's somebody here to sell you something, and caveat emptor, assess it, make your choice, and make the best choice. The financial space is unique, is that it gets presented, you forget that they're trying to sell you something. So that's one thing to bear in mind. Understand the conflicts of interest. The second thing is understand that you own it, and the risk and reward is yours no matter what. Just like however the investment performs, that's your risk reward. If the tax stuff that you do, if the IRS doesn't like it, that's your risk reward. It's not the person that sold it to you. So you have to take the ownership. And I think firstly, taking ownership and recognizing that will help people say, more than motivate it, I think it creates a paradigm shift. Now, let's talk real estate. Just again, use that analogy. You get presented with a deal and invest in this deal. Now, I can assess the deal, or I can assess perhaps the person presenting the deal, right? And both of those are important, but one of them is easier than the other to an extent, right? It's a balance of the two, right? You want to know who the operator is, who's the syndicator, both in terms of their competence, in terms of their character, in terms of the capabilities. And you also want to see, does this deal make sense? So it's a combination of those. So interacting with the financial space or the investment space, if you want to take a kind of shortcuts, you can do that, right? The ROI in taking shortcuts on your due diligence are, you maybe simplify your life, spend less time thinking about it, and you understand that potential downside is, all right, there's an increased likelihood that you'll miss something, but okay, that's the ROI. That's okay, right? You win some, you lose some. And if for you, the big win is, I'm going to focus on, do I trust this person? I'm going to get some character references. And I'm not going to bother the deal. I don't know the difference between a class A property and a class F. I have no idea what I'm looking at. I'm just going to focus on that. As long as you understand the risk that you're taking and the reward that you're getting by simplifying your life and not looking at it, and you understand that if you make the wrong choice and the deal turns out not to be a good one, that's wonderful. And if you're the kind of person that says, okay, I know the risk reward is mine and I want to invest time here to understand the deal, that's also great. They're both acceptable, just recognizing that there is risk and reward and it's yours.
I think that's, Bernard, I think that's where a lot of people take their misstep right there, is that they forget. And this isn't just about taxes or financial planning, or it's about life in general. There's like this huge disconnect that people have where they forget it's their life. Like, oh, wait, it's my life and my choice, and I have to live with it. Like, if this investment doesn't work out, or if I don't follow these tax strategies well and take this advice to heart, I'm the one that either wins big or loses big. And it goes even down to like basic life of living in community with people. You know, if I misstep there, I mean, I have to live with those consequences, for better or for worse.
Yeah, you got to own it. And I think that's where, I think that if people take ownership, and ownership doesn't mean that you do all the kind of the dirty work. Ownership doesn't mean that you manage a property, that you're doing the toilets and the roof and the boiler, right? But you have that oversight that you say, all right, this is enough. This is the level of oversight that I'm going to perform. But of course, I'm going to delegate.
I love that so much. So as we are preparing, this is going to air, sometime at the end of March, beginning of April, when people are going to either be like having these funny reactions of like, oh, I got this refund. And you and I'd be like, okay, good for you. Yay. But what are some things that you see overall that would support people in making some better choices, either in Q4 to set themselves up, like you and I said off air, like we can't go back and set entities up. So what are some structures in general that you see that people are just completely, you're consulting and you're like, how you guys are just missing the mark on this? If you would just move over like a millimeter, you would have a whole different thing going on.
Okay, there's one thing that I keep encountering. It's been put out on the internet by some folks, and I keep encountering this. And even with an attorney reached out to me, again, an attorney that it's not a tax attorney. And everybody kind of recognizes in their own domain, right? If I were to come into and think, I understand there's certain things that I can't assess, right? Try to get a rocket to the moon. I don't know where to start, right? All right. But then there are certain things that we can each look at our domain, our area of expertise, and we can see how some other people maybe think they get it, but they're just missing it completely.
Yes.
And they're so blind that they don't know where the blind spots are, right?
Yes.
So I would not say I understand real estate deals. I don't put them together. I invest in them, right? Right. I can definitely talk the talk. I can be dangerous. But I know I should be putting together the deals, right? It's good. I can assess them enough to know whether or not I want to put my money in them. But I'm sure, as you can see, people come in and say, hey, this is a great deal. And you're like, no, these guys, they don't know what they're missing. They just don't.
I've had that both sides where it's like, I don't know that I want to work with them, that would be the best fit, or, ooh, that deal isn't as good as it looks, as it's being portrayed, right?
Absolutely. And sometimes it's well-meaning people, but they just don't know what they don't know, right? Of course, there are folks that are not well-meaning, but there are also well-meaning folks that just don't know what they don't know. Ask me how I know.
Seriously.
Right? So when he crosses domains, people have to take that with him and recognize that, all right, I'm going to a domain where I have some information accessible to me. Maybe I've read this or seen that, but you don't know what you don't know. I
love that. You even have that. I like over on LinkedIn, it says, I wrote it down, and it says, you don't get what you do. What you get is what you don't see.
Exactly. Exactly it.
I love the way you said that.
That's exactly it. What you get and when you interact with the financial space is what you don't see. There's an incredible amount of value, right? If you're a deal sponsor that has experience and competence and expertise, right? But it's not written all over your face, right? And you've got a podcast and somebody else got a podcast and they've never even seen a deal yet, right? But to people that don't know the difference, it all looks the same, right? So anytime we transition to another space, we got to realize that we have unknown unknowns in those spaces. So I'm working, let's say, a tax attorney, there's not a tax attorney. There's an attorney, but you understand the attorney you would think gets that law is complex, right? And so even though they practice in real estate law and contracts and commercial law, you would think they would understand that it comes to taxes, that if they've seen one thing, they may be missing other things.
Right.
But it's amazing how people don't carry that. But if I were to start saying, I know enough about law that I can pretend again to know, right? But that attorney would look at me and say, Bernard, you don't know what you don't know. So we all have those. And let's talk about taxes, what I'm seeing here. This is the example. Can you set up a QRP 401k plan today for 2020 deductions? Julie?
No. Yes, it's retirement. I don't know. See, this is the area. And it's like, I know, but I don't know. Do I know? Ask me how I know. I don't know. That's why you go and you talk to professionals, right?
So if you go out there on the internet, you're going to find all sorts of stuff. The Secure Act passed late 2019 says you can a plan established before the due date. And so let's focus Qualified Retirement Plan strictly right now, because that's what this pertains to. You can establish Qualified Retirement Plan up to the due date of tax return of the sponsoring business, and it will be treated as if it was in effect for the prior year, right? Sounds cool, right?
It does sound cool. I'm like, wow, everybody, there's your place to go stash a bunch of money that,
And maybe, but there are a couple of gotchas. And so if you get out there on the internet, you're going to find all sorts of things out there saying, do this. Secure Act. Now you can set up your QRP and make your contributions for 2020, right?
Right.
The thing is, there are other areas that the Secure Act, for the most part, only applies to profit sharing contributions. And why is that? So how does a QRP 401k plan, how do those really work? If we go down to the mechanics, what's the magic that kind of make these operate that if you put money in there, you don't pay tax on it? So the technical term in the tax code is this is what's called a CODA, a cash or deferred arrangement. What does that mean? Yes, getting a little nerdy.
I'm like, this is so cool. Go nerdier.
So once you have money, you can't undo that you received the money. The idea is that, oh, you're going to get paid this amount of money, and instead of receiving it, you told your employer or the business, your own business, keep that money. I'm not taking it, stick it in the plan, right? But the moment the money came to you, you can't say at any point, oh, change of mind, I want to put it into the 401k plan. I want to put it into the QRP. It's too late. It's got to be done before the money is available to you. Now, so if you had a W-2, right? Let's say somebody got a W-2 and they got paid over the course of the year, $90,000, and their final paycheck is another $5,000. The most they can stick into the 401k plan at that point is $5,000. You can't say, oh, I want to take $10,000 from what I already got and stick that in, because you already got it. It's too late.
That's such an important piece for everyone to understand. I have a question. Can I interject, or should I let you finish? I should let you finish.
Yeah, let's take this just to the end of this piece of it. So you can imagine if you establish a retirement plan today, yes, it could be treated as an effect in 2020. But did you already get all that 2020 money? If you got the money already, it's too late. So did you get that money? Well, if the money was in a W-2, you got it already, right? If you are a self-employed individual or a partner, you got it already. So it's great that the plan is treated as being in effect for the prior year, but it's too late. You got the money, right? So where does it make a difference? Where it clearly plays a role is if the company wants to make a profit share contribution. So if the company, let's just say, has 10 employees, the employees can no longer put in any of their paycheck because they got that already. But the business can say, all right, the business is making a contribution for you guys, but the business can do that. But from the compensation, it's too late. So people are looking at the Secure Act and saying, hey, I can do this, right? The plan is treated as if it was in effect on the last day of the year. It doesn't help you. Even though it was in effect, the plan was in effect for 2020, but you didn't make any deferral elections. So it doesn't help you. Now, is there a way to have the cake kind of have it every which way? Very possibly. But what was your question?
Well, no, now I want to know about the cake. My question is stored away. Like I have it, I will ask you, but I think you're going to get to it. Tell me I want my cake and I want to eat it too. Okay.
So some of this is what we're discussing now is really, we need a little guidance about this from the IRS. So really what I'm pointing out is that what's being pitched to people is incomplete information. What's been pitched is incomplete because it'd be very likely that the IRS, according to a strict reading of the law, doesn't help setting up a plan. But there are those that are saying that the way it works out is not equitable because if you're a sole proprietor or a partnership, you're getting different treatment. Whereas if you were an SCorp. So the IRS has to come out and say that we want to equalize the treatment. And so you can do something even if you're a sole proprietor, but we don't know. We just don't know. Right. So now it comes down to, this is an investment. Make the choice, right? But what you see out there on the internet is, do this, Secure Act. You can do this. Set up a QRP now and do this. And like, No, there's another half of the story that you haven't been told. And it doesn't mean you shouldn't do it. It just means you need both sides of the story so you can make an informed decision, understand your risk reward, and then go for it, right? You're making decisions. So what's the way for perhaps to have it every which way? Is to set up a SEP IRA. Okay. A SEP IRA, you can definitely make contributions to. And you can, it's a little harder to hit the max limit in a SEP IRA, but at least you know on the profit sharing component, set up the SEP IRA totally above board, dump the money in there, and then you want to do a QRP? Sure, we'll set it up for you, and we'll just roll the money from the SEP. But you got the deduction using the SEP, and then you roll it, and this way you stay completely above board.
Oh, I love it. So it's just putting it into different entities to get to where you want to go, but do it the right way so that you're always above board.
And so you have no risk. You've eliminated all the risk, and now it becomes a no-brainer, right? If all I do is sell QRPs and just want to get you on that paperwork, this is not going to be so effective because now I'm saying, hey, set up a SEP IRA. But if I really want to help you and give you strategy, I don't mind saying, hey, do the SEP, put it in there, just so you get the tax deduction risk-free, and then roll it over.
Okay, so if you were listening to this, this is exactly why you want to be, if you're concerned about your taxes, your strategy, you know, and really like understanding how to navigate your finances in a powerful way, in a way that you are looking at it as an investment. This is exactly why you look out to Bernard. You call him up, you connect with him over on LinkedIn, because like, you're one of those like rare unicorns, Bernard, that will say like it's an extra step. And this is what separates people in this community is like, are you willing to do the extra step? It's more work, but it keeps you above the bar and it eliminates a huge amount of risk. And that right there, I'm like, that's why I wanted to have you on Ask Me How I Know.
I'm so glad to be here. You know, I love talking about these topics. And so this is great.
It is so great. Bernard, I could just like listen and ask questions for forever more, but I cannot believe I looked at my clock. I'm like, oh my gosh, we have to wrap things up. Is there anything else like that you would say? I really want people to hear or understand this little nugget.
I think to expand what we spoke about in the financial world, to really, even into the personal realm, I think taking this investment thought process where we all recognize we have to have a certain level of mental rigor, right? Yes. Assessment, ROI. I think we should all take that and, right, we pulled it into taxes, but we still stayed in the financial realm. I think you have to take that and pull it into even the personal domains as well. And I'll add to that, you have to, what the paradigm shift there is also recognizing that there are other ways to define ROI beyond the bottom line, right? So when we talk financial, even if tax, investments, it still makes it sound like ROI is measured in dollars and cents. But that's not really how it works. And so if we take this, we still want this thought process, but that's also going to, if we take it to the personal realm, it's going to force us to truly define how we do what's the ROI that we're looking for. Like you said before, it's life. What do we want from life?
I love that. Is such a fantastic way to wrap things up, Bernard, because ultimately that's it. The tagline for my company, 3 Keys Investments, is find your freedom. And, you know, your ROI isn't going to dollars and cents is not freedom. I mean, it might provide some financial perks in life and everything, but you could still be absolutely shackled with being miserable. So, you know, I love that. Fantastic. What is the best way for people to reach out and connect with you, or where would you like to send them?
I love connecting with people on LinkedIn. Almost everything we've discussed, I've posted at some point or another on LinkedIn. I use LinkedIn to get almost to crowdsource reactions to some of my thoughts. and to refine my thought process. I kind of welcome it's a platform where people are open. And if you stick your neck out, it might get chopped off. But it also can turn out really well, and you get to validate your ideas. I love connecting on LinkedIn. Of course, people can visit 401kcheckbook.com or resurefinancial.com. Google Bernard Reisz, Resure Financial, and hopefully you'll find good stuff. I think you will.
You will find good things. And I highly recommend, I really appreciate your LinkedIn posts. And that is where we connected. And I connect with the most amazing people like you over on LinkedIn, but you do put things out there. And sometimes they're just funny things, but sometimes they're edgy in the sense that a lot of people don't want to stick their head out there and say like, oh, well, let me kind of say this maybe contrary opinion or idea, but you're willing to put these ideas out there that challenge our thinking. And unless we're challenging our thinking, we're just doing this whole group thought thing, and it's not going to expand or go anywhere. So I appreciate that very much.
Thank you.
All right. Well, Bernard, I will see you over on LinkedIn. To my wonderful audience, I hope that you go and check out what Bernard has to offer, so that you can, clear the air and that you can become, just confident in navigating your finances, and make sure you reach out to him. Until next time, go find your freedom.